In the years before the scandal became public, Nirav Modi's name carried a polished kind of prestige. His jewelry brand appeared in prime retail locations and global fashion circles, presenting an image of meticulous craftsmanship and luxury. Behind that public shine, however, the business model relied heavily on steady financing because diamonds and precious stones often move through long supply chains where purchases are made first and sales returns arrive later. That gap between paying suppliers and receiving customer payments is where banks become essential. Trade finance exists to support legitimate commerce. A bank helps bridge timing differences so companies can import goods, process them, and sell them without running out of working capital. In India, one tool that had been used for this purpose was the Letter of Undertaking, or LOU, a kind of bank-backed assurance that made it easier for a firm to raise short-term credit from other banks for overseas payments. Punjab National Bank, one of India's largest state-run lenders, had a branch at Brady House in Mumbai, an address known for corporate banking activity. For years, that branch handled trade-related requests for firms connected to Nirav Modi and separately to the Gitanjali Group, associated with Mehul Choksi. As later investigations would allege, the relationship between certain bank staff and external firms became dangerously comfortable, and routine safeguards lost their force. The story surfaced not with a dramatic announcement, but with a procedural request that did not fit the records. In January 2018, when representatives of certain firms asked for new LOUs, bank staff reportedly requested the cash margin that policy demanded. The firm's side, according to widely reported accounts, responded that they had received such LOUs before without that margin. That single claim created a puzzle. If the earlier LOUs existed, where were the formal approvals? Where were the entries in the bank's core system? Once the questions were asked, the situation shifted quickly from unusual to serious. PNB reported the matter to India's banking regulator and filed a complaint that triggered formal investigation. Early estimates were already large, and they grew as banks and investigators mapped the web of obligations connected to the LOUs. What looked like one branch's irregularity began to resemble a wider operational breakdown. Permissions, records, and oversight were not lining up the way they should in a controlled banking environment. As the public learned the scale, often described in rupees as roughly 14,000 crore and in dollars as well over 1 billion, the scandal became a national lesson in how modern finance can be harmed not only by complex instruments, but also by simple lapses, a control not followed, a system not reconciled, a warning sign treated as someone else's problem. This first phase of the documentary story is not about glamour or gossip. It is about a basic truth in financial systems. Trust is not a feeling, it is a process. When the process is weakened, whether through complacency, poor supervision, or deliberate rule breaking, the damage can travel far beyond one desk, one branch, or one institution. To understand why the PNB case shook confidence, it helps to translate the banking mechanics into plain language. Trade finance is designed to help honest businesses pay overseas suppliers on time. Banks do this by issuing assurances that other banks accept. Those assurances must be supported by documentation, proper approvals, and accurate recording in the bank's core systems. The alleged problem at Brady House was that an assurance could be sent through a secure messaging channel used by banks worldwide, while the corresponding record did not appear in the bank's main internal ledger the way it should. When a bank's internal systems and its outward messages are not perfectly aligned, the bank begins to live two versions of reality, one inside its books, another inside the obligations it has quietly promised to others. Reports and explanations that followed described a pattern. LOUs were issued for specific firms, enabling them to obtain short-term credit from overseas branches of other banks. Because the receiving banks treated the LOU as a credible bank-backed assurance, they extended credit. When the time came to repay, new LOUs were allegedly issued to cover earlier ones, creating a rolling dependence on fresh assurances instead of a clean settlement cycle. This is not trade finance doing its job. This is trade finance being used to keep a costly loop alive. The most important educational point here is not the instrument's name, but the control logic that should have surrounded it. Authorization must be real, not assumed. A bank's promise should require documented approval by the right authority every single time. Recording must be immediate and complete. If the core system does not reflect the obligation, risk teams cannot measure exposure correctly. Reconciliation must be relentless. External messages and internal ledgers must match daily, not when time permits. Segregation of duties matters. No single role should be able to originate, approve, and transmit a binding assurance without oversight. The Reserve Bank of India later characterized the event as operational risk tied to failures of internal controls and employee delinquency, language that is careful but firm. The system did not simply miss something. Key safeguards did not work as required. When people ask, how could this happen at a major bank? The honest answer is uncomfortable. Large institutions can still be vulnerable when daily discipline erodes. Financial scandals are rarely created by one brilliant trick. More often, they grow in the quiet space where routine checks become optional, exceptions become normal, and uncomfortable questions are delayed. A defining feature of the PNB case is that it was not alleged to be a single moment of failure. It was described as something that expanded over time, with exposure compounding as obligations rolled forward. That long build is what turns a localized control breach into a system-wide headache. In a healthy trade finance cycle, credit supports movement of goods and is repaid from real business cash flows. In the alleged pattern here, the cycle became distorted. Short-term credit was repeatedly supported by fresh bank assurances rather than by routine settlement. As the loop continued, the gap between what the bank thinks it owes and what other banks believe it is owed could widen, especially if internal records were incomplete. This is where organizational behavior becomes as important as technology, because even if a loophole exists, a bank still has multiple lines of defense: branch supervision, internal audit, risk management, compliance review, and periodic inspections. For a long-running irregularity to persist, those lines of defense must either be bypassed, weakened, or treated as formalities. One lesson for listeners is to watch for the warning signs that often appear in hindsight: unusual concentration of business with a small set of connected firms, a relationship-driven environment where staff feel pressure to keep clients happy rather than follow policy, repeated exceptions that are justified as temporary, weak documentation standards where missing files are tolerated, overconfidence in reputation where a brand's prestige substitutes for verification. Public reporting also emphasized that multiple entities were involved: firms associated with Nirav Modi and with Mehul Choksi, adding complexity to the web of transactions and making it harder for a casual observer to see the full picture. Complexity itself is not wrongdoing, but it can hide patterns when teams are understaffed or overly reliant on trust. For the educational tone of this documentary, it matters to say clearly: describing control gaps is not the same as teaching someone to exploit them. The purpose is the opposite: to help professionals and everyday viewers recognize how normal processes can be bent when oversight becomes passive. When the case became public in 2018, the immediate question was, how large is the damage? But the deeper question was, how many chances were there to stop it earlier? In major institutions, the earliest prevention is rarely one heroic moment. It is hundreds of small choices: a supervisor insisting on proper entries, an auditor refusing to accept vague explanations, a risk officer asking why exposures don't reconcile, a team leader refusing to treat policy as an option. Once PNB disclosed the fraud allegations, the consequences moved in multiple directions at once: financial, regulatory, and cultural. Financially, the bank had to recognize and provide for losses linked to the disputed obligations. Even when recoveries are later made through asset sales or legal processes, the immediate accounting impact can be painful. Provisions rise, profitability falls, and public confidence takes a hit. The case also placed pressure on the broader banking system because other banks that had extended credit based on LOUs needed clarity on repayment and liability. Regulators responded with actions aimed at closing the specific loophole and reinforcing control expectations. In March 2018, India's central bank discontinued LOUs and similar instruments for trade credit, an unusually direct move that signaled the regulator's view that the control environment around these tools was not strong enough. This matters historically. Rather than merely tightening guidance, the instrument itself was effectively removed from the toolkit, pushing banks toward more robust alternatives and better documented trade finance structures. At the legal policy level, India also accelerated frameworks intended to deal with major economic offenders who remain outside the country's reach. The public conversation emphasized asset attachment and the ability to confiscate properties tied to alleged wrongdoing, less as a punishment narrative and more as a restitution and deterrence mechanism. For viewers, the most practical learning here is how reforms typically follow a pattern. The loophole is identified, messaging systems not aligned with internal ledgers. The instrument is restricted or retired, LOUs discontinued for this use. Banks are pushed to strengthen governance, reconciliation, audit, accountability. Recovery efforts begin, asset tracing, liquidation, restitution. A careful, non-sensational documentary tone also notes that reforms are never purely technical. A new rule cannot replace professional skepticism. Systems can be upgraded, but if teams still treat exceptions as normal, problems return in a new form. The PNB case became a reference point in India's banking conversations for years because it combined recognizable elements, a famous brand, a trusted public institution, a specialized product many people had never heard of, and a control failure that sounded surprisingly basic. The result was not just a scandal headline, but a permanent reminder that banking safety depends on boring things done consistently, entries made on time, approvals checked, systems matched, and responsibilities clearly separated. After the initial disclosures, the story entered a second life, the long procedural phase of investigations, court actions, and cross-border legal steps. This phase often receives less attention because it is slow, technical, and filled with hearings, but it is where accountability and recovery are actually pursued. Nirav Modi left India before the scandal became public and was later arrested in the United Kingdom in 2019, where he has remained in custody as extradition-related proceedings continued. Over the years, Indian authorities pursued multiple tracks, including the core bank fraud case and related financial crime proceedings. Public reporting in late 2025 indicates that efforts to revisit or reopen parts of the extradition appeal process were deferred into early 2026, with the UK court considering assurances related to detention conditions, an example of how extradition cases can hinge on detailed procedural standards, not just allegations. There are also signs of direct cooperation between courts. Reports in January 2026 described a UK court seeking assistance from Delhi's High Court to record a statement connected to the case, an illustration of how modern financial cases can require judicial coordination across borders. Meanwhile, Mehul Choksi's situation has also developed internationally. In 2025, major news agencies reported his arrest in Belgium following an extradition request, and Indian courts continued proceedings connected to the case even as extradition litigation unfolded abroad. This parallel track matters. Legal systems can pursue domestic processes while international custody questions are still being argued. Alongside extradition, recovery and restitution efforts have been ongoing. Financial investigations often focus on identifying assets, attaching them under law, and moving them into channels that can ultimately compensate affected institutions. Recent reporting has described transfers of attached properties linked to the accused toward liquidation or restitution processes, steps that may not feel dramatic but are central to repairing losses. For an educational documentary, the key takeaway is that accountability in large financial cases is rarely instant. It is built through documentation, lawful process, and persistence. Courtrooms are not designed for speed, they are designed for standards. That can be frustrating to the public, but it is also what makes outcomes durable. The Nirav Modi PNB story is often summarized as a bank fraud involving guarantees, but the more valuable educational framing is broader. It is a case study in operational risk, how everyday systems fail when controls, culture, and accountability drift apart. Here are the lasting lessons that travel well beyond one country or one bank. 1. A trusted channel is not a trusted transaction. Banks can send secure messages, but security is not the same as authorization. The most advanced network still needs internal controls that confirm every obligation is properly approved and recorded. 2. Reconciliation is not paperwork, it is safety. When a bank's outward commitments do not match its internal books, risk becomes invisible. Invisible risk is the most dangerous kind because it cannot be managed until it is already large. 3. Reputation must never replace verification. Prestige brands and high-profile clients can create an emotional bias. People assume this must be legitimate. Strong institutions train teams to treat every counterparty as verify first, without hostility but without favoritism. 4. Small exceptions become big patterns. The early warning signs are often tiny: a missing document, a delayed entry, an approval that is understood. Over time, these exceptions can form a parallel system where rules exist only on paper. 5. Oversight must be designed for real life. Controls that work only when everyone is perfect will fail. Good design anticipates fatigue, staff turnover, pressure, and attempts to shortcut processes. That means clear segregation of duties, automated checks, and audit trails that cannot be quietly bypassed. 6. Prevention is a leadership skill. The best controls still depend on leaders who reward caution, not just growth. If staff feel punished for slowing down a valuable client, they learn to stay silent. Healthy organizations treat questions as professionalism, not disloyalty. Finally, the case illustrates why reforms often come in two layers: a technical fix, retiring or restricting a risky instrument, and a cultural fix, rebuilding discipline and accountability. The Reserve Bank of India's own framing, calling it an operational risk event tied to control failure, points directly to that dual lesson. A gentle, non-sensational conclusion is appropriate. Financial systems are built to support real trade, real jobs, and real livelihoods. When controls fail, the harm is not abstract. It spreads to trust, stability, and opportunity. The purpose of studying this case is not to dwell on scandal, but to strengthen the habits that keep institutions reliable. Verify, record, reconcile, and never let prestige outrun process.